and welcome to March 2026 edition of Macro and Market Outlook. Looking at the global developments, artificial intelligence-related capital expenditure remains one of the most resilient components of global demand. These outlays are not only supporting growth within the technology sector, but also spilling over into adjacent industries such as data centers, semiconductors, utilities, industrial automation, and logistics, thereby creating a broader uplift across the real economy. For now, this investment cycle is strong enough to keep overall growth momentum intact and is even contributing to a modest revival in global manufacturing sentiment, particularly in export-oriented economies. Consumer confidence in the emerging market, ex of China, is on the mend. Labor market dynamics in the US are sending mixed signals. Fears around AI-related displacement have contributed to some cooling at the margins, especially in the tech and services sectors, yet the broader US labor market continues to exhibit pockets of resilience, preventing a decisive shift towards weakness. Inflation expectations, however, remain contained. Both wage and services inflation in the US have shown signs of easing. That said, the upward drift in commodity prices, extending beyond precious metals, represents a new emerging risk. On the policy front, the global monetary cycle is becoming increasingly desynchronized. Reserve Bank of Australia was among the first major central banks to end its easing cycle and hike in 2026. Japan continues to normalize rates gradually. In contrast, expectations of Fed rate cut have also been pushed out into the second half of the year as US activity indicators, particularly consumption and business investment tied to AI, remain resilient. Looking ahead, while there is a legitimate debate about whether AI-driven investment could culminate in a bubble with recessionary consequences, the current phase is clearly contributing positively to global activity. If commodity strength persists and economic data resists further weakening, markets may eventually price the risk of a bear steepening in yield curves. This would reflect rising term premiums and the possibility that long-end rates drift higher even if central banks remain cautious. Such a backdrop would argue for avoiding global duration exposures. In summary, today's environment continues to favor equities, particularly those linked to AI, industrials, and selective EM growth stories, as well as targeted exposure to global commodities. If there is a theme across EM underpinning the strong performance, it is the dollar weakness. For the very near future, US macro resilience, hawkish Fed signals, and Iran-related geopolitical developments could keep dollars sideways. But from the medium-term perspective, with global growth shaping well, USD may remain soft through large part of 2026. Even now, Chinese officials also appear to be getting more open for RMB appreciation. Tariffs were once again in the news this month. First, for India, we got a positive news that in early Feb, that India-US trade deal has finally fructified. And then later we got the news that this doesn't even matter because US Supreme Court has invalidated the IPA-related tariffs. Instead of reducing confusion regarding the future trajectory of the US trade policies, the strike down of IPA tariffs will lead to an even greater unpredictability. US President is doubling down, insisting on using other avenues. He has already announced that he will use an alternative avenue by deploying Section 122 of the 1974 Trade Act to impose a 15% tariff to replace IPA. These tariffs will not be additive to other industry-specific tariffs such as on steel and aluminium imposed under Sections 232 and 301. Also, numerous carve-outs to reduce disruption and lower affordability pressures will remain in place. Depending on what other reliefs are granted or hikes are taken, average tariff will likely return to pre-SCOTUS level. But the legality of Section 122 is just as fraught with uncertainties as IPA. Another problem is that Section 122 cannot differentiate between countries, and these tariffs last only 150 days before needing to be submitted to the Congress, though there is a possibility of an extension. Now, coming to India, January 2026 data point to some moderation in high-frequency indicators, although the overall growth trajectory remains positive. We began to see early signs of economic momentum supporting earnings in third quarter FY26, and we expect these positive trends to continue through fourth quarter FY26 and into FY27. There are several factors driving India's growth recovery. First, monetary and regulatory easing is now translating into private credit growth, being better. Second, GST rate rationalization has supported consumer discretionary demand, with autos being a key beneficiary. Lower inflation, improved affordability following GST cuts, and easing interest rates are collectively supporting both rural and urban consumption. Third, exports, previously a laggard, may be poised for some revival, given that there is now a level playing field for India in terms of tariffs. Fourth, the latest union budget has clearly placed more focus on supporting private capex. After adjusting for various factors, effective infrastructure spending by the centre is budgeted to rise by 18% in FY27, reversing the modest contraction seen in FY26. In addition to the direct capex, production-linked incentive schemes remain a supportive indirect driver of private investment. The government has also incentivized investments in data centers through tax holidays, launched an R&D fund to catalyze innovation-led capex, and introduced other measures to stimulate private demand investment in strategic sectors. Fifth, rising commodity prices are likely to support commodity producers, particularly in metals and oil and gas. There may also be a gradual return of pricing powers across select sectors. That said, certain areas remain weak. Residential real estate momentum continues to disappoint expectations. While developers remain optimistic about the outlook, this optimism is yet to translate into measurable performance. Additionally, the recent volatility in global IT and technology services space due to AI developments could pose risks to India's services exports, which had remained resilient post-COVID. In summary, our confidence in the Indian economy has strengthened following last year's policy adjustment, the recent union budget, and the trade developments. While pockets of weakness persist, the balance of risks appear more favorable, with improving credit growth, consumption recovery, supportive fiscal policy, and easing tariffs underpinning the outlook for FY27. Consequently, we also place a more optimistic outlooks of the earning trajectory in FY27. Indian equities entered 2026 with elevated volatility. Markets fell in January, Nifty by 3.1% and Sensex by 3.5%, but they remained largely flat in February, with only a marginal Nifty uptick of 0.5%. Post the trade deal, FPI trends show nascent signs of bottoming out. That said, India still underperforms the other EM nations in terms of the quantum of FPI flows. India's valuation premium relative to other EMs is now back to historical averages, improving the entry points. With EM interest returning, India may see stronger allocations by the FPIs. As just said, we are positive on India's nominal growth and consequently the profit outlook in FY27, though we do need to watch out for rising commodity costs. Overall, we expect positive but moderate equity returns with a preference for large caps, which currently offer more attractive valuations versus the broader market. Interest rates in India have been rising across segments. This rise is visible in money market, government securities, and corporate bond yields. One of the most notable developments has been the significant steepening of the yield curve. The underlying reason is that both private sector credit and government borrowing are expanding simultaneously, creating a tight supply-demand dynamic in the fixed income market. Banking system dynamics are central to this development. Credit growth has been outpacing deposit growth within the banks. This results in two consequences. First, banks' participation in SLR securities declines. Second, banks are forced to mobilize funds aggressively through certificate of deposit issuances and bulk deposits. Certificate of deposit, that is CD spreads, in fact have widened sharply and are currently even higher than levels seen during the 2018-19 IL&FS crisis period. This indicates tight liquidity conditions in the short-term market. Interestingly, while SDL supply has also risen significantly, spreads on these instruments have remained relatively contained because market had already anticipated the supply increase well in advance. Turning to inflation and monetary policy, inflation appears likely to inch up further over the coming quarters. As a result, the case for further monetary easing in 2026 appears weak, and a status quo on Indian policy rates seems more probable. We continue to think that liquidity tools and actions will remain a center stage of RBI's monetary policy in 2026. Looking ahead, elevated currency in circulation expansion during the month of March and April are likely to create additional liquidity tightness. Although some of these pressures may ease in the month of May with RBI dividend, but for now, liquidity support from the RBI may still be required for next couple of months. From an external sector perspective, balance of payment dynamics may provide some relief. Earlier, adverse sentiment driven by tariff concerns has largely subsided, and FII trends appear to have bottomed out, though one needs to watch as to how long does this Iran-related geopolitics imbalances continue and how long will they keep Brent above $70 per barrel. As of now, the net BOP dynamics appear to be more neutral, versus a sharp deficit in 2025. This should help to lower the pace of depreciation for rupee in 2026. From the GSEC perspective, the current narrative is characterized by tight supply-demand conditions in domestic bonds, elevated credit-to-deposit ratios in the banks, substitution between bank credit and bond markets, gradually firming inflation, monetary easing largely done in India, ongoing but absorbed liquidity support, and improving external dynamics that may offer only a marginal relief, with valuation no longer as compelling on forward inflation basis and global easing expectations getting pushed out. The case for aggressive duration positioning appears limited at this stage. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.